the big macro trend of the next 10 years is that this global south is integrating ever faster. For all the talk about deglobalization, what we're really talking about is the splitting of the world into these two blocks. But within each block, you're seeing accelerating integration. More trade from Africa to Asia, more trade from Latin America to Asia,
more trade from China to the Middle East.
More trade from China to the Middle East, more financial flows, more investments from the Middle East into China. And all this is happening at an accelerated pace, and it's going to increasingly happen in currencies other than the US dollar.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. While most eyes are focused on what the Federal Reserve will do next, many of the most important developments shaping events here in 2023 are happening outside the US. Russia's invasion of Ukraine upended the geopolitical chessboard, as well as world trade and the energy and financial markets, and yet it continues raging on over a year after its outbreak. China, too, is making waves that all nations will feel as it reopens its economy after years of COVID lockdown, while its relationship with the West continued to become more strained over Taiwan. What large and long-lasting implications will these global developments have? To better understand the situation from a non-US perspective, we're fortunate to welcome back to the program Louis Gav, founding partner and CEO at Gavekal. Louis, it's a pleasure to have you back on. Thanks so much for taking the time to join us today.
It's my pleasure. Thanks a bunch for having me.
Oh, great. Well, I've been really looking forward to this, Louis. We have a surprising number of international viewers here at Wealthion, and a very fair question I get asked pretty often is, hey, can we get some perspective outside of just the US? So with that said, I am going to ask you some questions about the US to kick things off, but then we'll get into the rest of the world. Real quick, though, let's start with a question I like to ask all my guests at the beginning. What's your current assessment of the global economy and financial markets?
That'll be an hour right there.
Yeah, I know.
I'm, how long-winded I get. Look, my assessment is, to be honest, that things are extremely, extremely challenging right now, both on the structural front and the cyclical front. On the structural front, I think we have to acknowledge that there's dramatic shifts undergoing on a number of key variables. The first one you alluded to already is the fact that we live in a world of rising geopolitical tensions. For now, it seems like you have a new Cold War unfolding itself, and we have to hope, of course, that it remains a sort of new Cold War with sort of proxy battles such as Ukraine. But however you cut it, whether it's a hot war or a Cold War, the sort of 30 years of era of peace dividend, of globalization, et cetera, is probably behind us. And that's probably inflationary. My friend Luke Groman likes to say that if truth is the first casualty of war, the second casualty is bonds. Wars are fundamentally inflationary. They're bad business for fixed income investors. So that's a first problem. A second very important shift is, most Western and even some of the large emerging markets such as China, South Korea, and others are going through a very important demographic shift. I mean, we're aging. Workforce are shrinking everywhere, and you see the consequences of it, right? Wherever you are in the world, whether China, France, Germany, Britain, US, everywhere, every entrepreneur has the same story. They can't find workers. Again, I think that's this dearth of workers and the new inflationary development that we haven't had to deal with for 30 years. For 30 years, I lived in a world where China alone was adding 20 million workers to the global workforce year in, year out.
Cheap workers.
Cheap workers, just unleashing them onto the global economy. And that's over. So that's, a second big shift. We're going through an energy transition. I think there's big question marks over the global monetary system and whether the US dollar remains the undisputed reserve currency of the world as it has for the past 70 years, partly because, as we move into this new era of geopolitical strife, currencies are being weaponized. And so if you're in a country that is not so friendly with the US right now, whether the country in the Middle East or China or elsewhere. How comfortable are you keeping your assets in US dollars? And then, so that's for the structural elements. Then if you look at the cyclical part of things, of course, you have a Fed that is tightening aggressively now. But against that, you have, still very loose fiscal policies in the US. You still have municipalities, state governments, and even a federal government that's basically spending money as if it's going out of style. So you get very sort of, I think, very mixed signals. From on the one hand, still very easy fiscal policies, big budget deficits everywhere, and on the other, tied to monetary policy. If you look at internationally, I think the picture is less confusing. The big thing internationally, you mentioned it, is China reopening. I think 6 months ago, most people were expecting China to have zero growth this year, or maybe 1%, maybe 2% at most. And here we are. I think we're going to have 6% GDP growth this year. And I know they've given themselves a 5% target, but that's just so that they can outperform. I think we're going to end up with 6% Chinese GDP growth. And, how many people have taken that into, have adjusted their portfolios to the reality of a China that's growing by 6%? I would argue still very few, because this is a brand new development. And so, you have the world's largest economy, i.e. the US, where the central bank wants to clearly slow things down, and the second largest economy in the world, i.e. China, where policymakers clearly want things to reaccelerate. So, lots of cross currents here, and not obvious. And again, all of that is fairly unprecedented. If you look at the last big rounds of Chinese stimulus in 2008 and in 2015, both times the US was also stimulating. Both times the US also wanted things to get going, post 2008 crisis. And so it's the first time where you really have the two, by far behemoths in the global economy going at cross purposes. And they're going at cross purposes on every front. They seem to be clashing on everything, not just monetary and fiscal policies these days. So, to deploy capital in this environment is, let's not kid ourselves, it's extremely challenging. And I think you have to do it with a lot of modesty. You have to do it acknowledging that you're not going to have all the answers, because there are just too many questions. When there's just one or two important questions, it's a pretty simple decision tree. You ask your question, you go yes, no, and then you look for the signs. When you have 6, 7, 8, 9 important questions, and each time you have yes, no, yes, no, yes, no, you end up with 64 different possible scenarios. Much more complicated.
All right. As we get near the end of this discussion, I want to get into, okay, given that challenge, how are you thinking of capital allocation in this type of environment? But beforehand, we got a lot of wood to chop, because you just gave me an awful lot of topics that I want to dig into with you on virtually all of those. Let's start, if we can, with Fed policy. And I probably will revisit some of the structural things you talked about, but right now, you kind of, most eyes are to the Fed, even on the day that, the week that we're talking here, Louis. We had the Fed just speak yesterday, I believe, and Powell came out and was continued to be, super hawkish, to say, look, I'm going to keep hiking. Fed officials have come out and sort of continued to raise the trial balloon of, hey, we may have to go above 5%. Maybe 6% is the right new number. Higher for longer definitely seems to be the policy of the moment. I got a number of questions for you on this, but real quick, as I was preparing for this interview, I saw that you were quoted in an article titled, "The Greenspan put era is over and not a millisecond too soon." Now, that wasn't quoting you, but the article had a quote from you in there. So I thought I'd ask you, is that title accurate? Is the put over?
I think it is. I think it is over, or at least it's been repriced at a much lower price. I still think I also think perhaps the Greenspan put today isn't really on equity markets as much as it is on bond markets.
Okay.
And I think this is what you saw in 2000, to be honest. When the COVID crisis hit, initially equities sold off and the Fed did nothing. And it was when the US Treasuries sold off that the Fed stepped in into a big way. Because fundamentally, and you saw the same thing, by the way, in Britain, sorry, this summer.
With the gilts, yeah.
With the gilts, the equity market was doing poorly, and the Bank of England was like, yeah, whatever, don't care. And then the Bank of England was tapped on the shoulder and told, well, look, if gilts yields stay at 5% by the end of today, all the pension funds are bust.
Our pension system's dead, yeah.
The pension system is dead. So we're going to, so the Bank of England did a complete 180. They went from saying they were going to do QT to once again re-embracing quantitative easing and going out and buying bonds at the long end. So, and this comes down to a simple truth that, most people think central banks have two mandates, a mandate on inflation and a mandate on employment. The reality is that central banks have three mandates. They have a mandate, of course, inflation, of course, employment, but their most important mandate is they need to keep the governments funded. They need the bond markets to stay functional. And if bond markets get dysfunctional, central banks have to step in, because if they don't, governments don't get funded. And if governments don't get funded, then they don't get paid at the end of the month. And so I think there is still a central bank put. It might not be on equities, and it's on government bonds. And I think there's a good chance it will get exercised sometime this year with everything that's unfolding in the world. Now, having said all this, on this discussion on the Fed, it is interesting that it is the core concern, what everybody's talking about all day long is the Fed, when there's perhaps much more important things going on. These sort of new geopolitical tensions, this deglobalization, the Chinese reopening. For me, all of these are more important than whether interest rates go up 25 or 50 basis points. To me, that matters a whole lot more for the long-term return profiles of the investments that I may wish to make. I think the reason everybody wants to focus on the Fed is twofold. Is first, we have an entire generation of investors that has been brought up, excuse me for the picture, but basically sucking on the tit of the Fed, right? We've just learned to live to be given things by the U.S. central bank, and so when they take it away, we all start crying like big babies. But there's a whole lot more going on right now than that. So that's number one. And I think the other reason, frankly, everybody focuses on the Fed is that it's something that's pretty easy to measure. It's like, okay, are they going to do 25 or are they going to do 50? And you can spend all day discussing it, and then in a month or in 3 weeks or in 2 weeks, so it's something to put into your model, right? It's that old story of when Eisenhower was planning D-Day. He asked the weather forecasters, and he asked them in April, he said, give me a weather forecast for early June. What day is going to be better for a landing? And the guy said, well, there's no way we can know 2 months in advance what the weather will be like in early June in France. And he said, it doesn't matter. I just need a forecast for my, it doesn't matter if it's right or wrong. I just need the forecast for my model. And the same is true for the Fed, I think, for a lot of people's, how they conceptualize financial markets. So it's easy, am I going to get 25? Am I going to get 50? It gives you, in essence, the illusion of certainty, something you can plug into the model, which you can't do when you talk about Chinese-U.S. tensions,
right.
which you can't do when you talk about the rising tensions in the labor market because of the lack of workers. These are hard things to plug into a model. As opposed to a 25 or 50 basis points increase. So by talking about a 25 or 50 basis point increase all day, we can sort of avoid this other stuff that's harder to conceptualize, harder to modelize, but that ends up being much more important.
Okay, I want to get to those topics in just a moment. The thing I'm most interested in kind of getting your thoughts on around the Fed topic is one Fed action influences a lot of the rest of the world, like a lot of other central banks follow the Fed's lead. And right now it is.
I'm not sure that's true anymore. I'm sorry to interrupt you.
Okay,
but
it may not be. I mean, China's not, obviously.
No, China's not, and that's the second biggest economy in the world. But look, when inflation first started to appear a couple years ago, most emerging markets said, "Hold on, I've seen this movie before, and this I don't want to repeat. Thank you very much. I don't want a sequel." And so, before the Fed even did anything, Brazil had already hiked 1,000 basis points. Chile had already hiked 800 basis points. And this comes down to the old story. You don't make your father's mistakes, you make your grandfather's mistake. Remember, a year ago, a lot of Fed directors were still talking about how they wanted inflation higher for longer.
Oh, absolutely.
A year ago, they were actually still, this time last year, they were still doing QE. Inflation was already at 6%, and they were still buying U.S. Treasuries.
Right. And mortgage-backed securities.
So, the idea that foreign central banks follow the Fed in this cycle, emerging markets tighten much before the Fed. China's always has been doing its own thing, but then China's always done its own thing. It's a big enough economy, plus it's got capital controls, so it can afford to sort of, dance to the tune of its own drums. Japan is also clearly doing its own thing.
Yep.
So the Bank of England has now fallen off the cart. They fell off the cart in September when they said, okay, well, basically we have to go back to QE. And I think the ability of the Bank of England to tighten is now extremely constrained. So you're really left with the ECB, which, is sort of following the Fed in a haphazard way, but that's about it.
Okay, great distinguishing, and that's going to get into our ex-US discussion here in just a minute. But what interests me about this topic, which I want to get your thoughts on, is we have it's a couple of things. We have slowing growth, right? One of the questions I'm going to ask you in a minute is how much of a reprieve may China's reopening give us on that? Sort of in relation to a possible global recession. But the Fed is increasingly finding itself in a bind here, right? Where it's now dealing with the inflation monster, which it didn't have to deal with for the past bunch of decades, right? It's raised interest rates really dramatically to combat that monster, but the monster's not dead yet by any stretch. The higher it raises these rates, the more strain it puts on our over-leveraged economy, and it makes it harder and harder for the government to fund itself, as you were saying, right? The debt service costs become more and more burdensome as time goes on. So it's kind of like, how does this resolve, do you think? Right? Because it sounds like you're thinking that something may force the Fed, as you said earlier, to go back to easing because it's got to rescue something like the bond market. But then inflation, potentially comes back to life.
Look, I think my belief for a while has been that we've moved into a structural inflation environment. And this for a number of reasons, partly because of the knuckle-headed energy policies we've followed for the past decade or so, partly because of the rise of geopolitical tensions, and against this, monetary policy is, what can monetary policy do about rising energy costs? What can monetary policy do about the fact that the US wants to produce less in China and therefore needs to move production back to much more expensive destinations? It's
nothing except maybe make it worse.
Yeah, exactly. By making capital spending more expensive and therefore harder to achieve. So look, I think we are in this inflationary environment. The one thing tied to monetary policy can do is at some point break the back of the unconstrained fiscal spending we've seen in the US and in most other Western nations. So the age of zero interest rates obviously led to, I think, promoted bad behavior, excess financial speculation, et cetera, amongst private market participants. But it also meant that governments, of course, never had to account for stupid spending. 0% interest rates promotes really bad behavior from governments. And so I think eventually this is what will break. So this brings me to your question on, what does China's reopening mean for us? I guess it all depends on who the us is. China, because different countries will benefit disproportionately from China's reopening. I think China's growth is going to be very strong this year. And when China does well, usually Japan does well, South Korea does well, emerging markets do well. Europe manages to benefit from rising Chinese growth. Historically, the US a lot less for a simple reason is that the US economy is first and foremost about the US consumer. Exports are really a fairly marginal factor into the overall US GDP growth at the best of times. But let's not also kid ourselves that the whole deglobalization, let's reduce dependency on China knife cuts both ways. As the US blasts China also wants to do less business with the US. It's not that surprising. Since and I think we talked about this last time we chatted, but since President Trump destroyed Huawei in 2018, every Chinese CEO has spent the past 5 years trying to de-dollarize their own supply chain. Nobody wants to be Huawei. Nobody wants to be told from one day to the next, you can't buy that essential piece of machinery or that essential intermediate good that you used to buy in the US, you can't buy it anymore, and therefore your business implodes. And so as China rebounds, I think what we're going to find is that you're going to see very strong Japanese exports into China. You're going to find very strong European exports into China, and you're going to find very weak US exports into China because every CEO has spent the past 5 years de-Americanizing their supply chain. Now, which brings me back to, okay, if you're the US, the big growth story in 2023, 2024 will be the China story, and you're not going to really participate in it, then what are you left with? You're left with an economy that will likely disappoint, and that will likely disappoint at a time when other economies are actually most likely outperforming expectations. And so I think that will be, weaker US dollar. It'll put with a weaker US dollar, it'll put the treasury market under further pressure. And that brings you to the real quandary, which is, the real purpose of tighter monetary policies is to put fiscal spending back into its box, to basically bring fiscal discipline to the various branches of the U.S. government, whether that be at the municipal level, the state level, the federal level. And frankly, we're not there yet, right? Things haven't broken on this front. You haven't had any politician really stand up and say enough with the spending, as you saw with, say, Margaret Thatcher in the 1980s in Britain. As you saw, frankly, with Bill Clinton when he came to power, and along with Newt Gingrich brought budget deficits into the U.S. back into equilibrium. Instead, you've gone from 3 trillion debt in 2000 to 31 trillion debt today in the United States. So much so that this year, the debt servicing costs of the United States are moving from $800 billion a year to $1.3 trillion a year.
Right. In a single year.
Yeah, a $500 billion increase. Now, $500 billion increase, that's a bite. Now, here's the bad news. It's going to be if the interest rates stay the same, it's going to be another additional $500 billion next year because of the way the debt rolls over, because so much of the American debt is at the short end. So, I think, everybody's saying, while looking around saying, oh, the Fed hiking is going to break something. They're going to break the real estate market, or they're going to break the consumer, or they're going to break the foreigners because the dollar is going to go up too much, etc. Look, what needs to happen is for the Fed to break U.S. government spending. And I think that's invariably that's what will happen. And it'll happen first. You'll see a meltdown in U.S. municipal bonds and state government bonds and in federal bonds themselves.
All right. So you're looking for trouble in the bond market to come out of
Absolutely.
this.
Uh,
Okay.
um,
And let's just pull on that string for 1 second about getting sort of fiscal spending under control here, because you're right. I can say this as an American. We just have no backbone or appetite on Capitol Hill right now for belt tightening, for austerity, and the voters aren't asking for it. In fact, they're asking for the exact opposite, right? Like, hey, can we start those stimulus checks back up again, guys?
yeah, they
Right?
were nice. They were nice. I'll
Yeah.
have some more, please.
Yeah, exactly.
Yep.
So if we end up getting trouble in these markets, how do you see us getting to the realization that we've caused this and we need to, get our spending under control versus just going back to doing what we like to do, which is just, okay, bailouts for everybody?
Well, I think the trouble is already there. To be honest, if you look, everybody looks at the shape of the US yield curve and says, oh, you got a big inverted yield curve. Never has it been inverted this much, or not since whatever, 30 years, 40 years. And therefore we got a huge recession coming, et cetera. Like, how many times have you heard this in the past few months?
Oh, an awful lot.
Yeah. No, if I had a martini every time I'd heard that, I'd probably be drunk, more than drunk. I'd be dead by now.
Right. And I've probably said it myself several times too. Just being honest. Okay.
But here's the interesting thing: is why is the 2-year selling off as it is and not the 10-year? And I think it has a lot to do with the term structure of debt. You look at the term structure of debt, and basically all of the US debt is 0 to 3 years, like almost all of it. There's been no issuance at the long end whatsoever. Now, that the demand for debt is at the long end. It's, your insurance companies, your pension funds, they need long dated debt. And the government isn't providing it to them, because all the government is doing is issuing short-term debt. So yields at the short end go through the roof. Yields at the long end don't, because of the lack of supply. And
I'm sorry, can you just clarify for folks why you think there's a lack of supply there? If the demand would be there, why wouldn't they do it?
The government hasn't issued 10 years. They've just been issuing 1 year. They've been issuing 1 year, 2 years.
But what's the government's rationale for that? Do you know?
I don't know. You should ask them. I think it's a
Okay.
huge mistake.
Yeah.
I think it's a huge mistake. I think they did it in the Trump years. They did it because it was cheaper debt this way, and they thought interest rates would probably stay low forever.
Yeah.
I think they've been surprised by how quickly things have turned around. But if they should have done what the Austrians did 3 years ago, which is, oh, you like this 0% interest rate paper? Here, have 100 years.
Here's 100 year, yeah.
Here's 100 year. The Italians did 50 years. The Brits did 50 years. It's like, oh, you like this paper? Have it. I think that 100-year Austrian bond is trading at like 26 cents on the dollar now or something.
Yeah, surprised it's that high.
They've crushed it. Well done, the Austrian Treasury. If I was an Austrian taxpayer, I would, give these guys a medal. It's like, well done. The US government did exactly the opposite. The US government massively, during the years of 0% interest rates, shortened the duration of their debt to save a few basis points. But it's a few basis points that are going to end up costing it a lot, I think, over the coming years. Because now that interest rates are lower for longer, are higher for longer, rolling over that debt, as we're saying, you move from 800 billion a year to 1.3 trillion a year, while most European countries don't really have debt to roll over, so their cost of funding. The interesting thing is, if you look at the past really 4, 5, 6 years, every US consumer basically extended the term of their debt as much as possible. Everybody locked in 30-year mortgages at 3%.
Yep.
Everybody in America did that, so much so that 99% of mortgages today in the US are below the current mortgage rate. Everybody well below. No, it's so everybody locked in. Everybody did it except the US government. The US government went exactly in the opposite direction and said, yeah, I'm going to issue all my debt at the short end, basically rolling paper. And today, everybody runs around saying, oh, the big problem is going to come in with the US consumer. Well, no. They were smart. They locked in 3% and they're sitting pretty. The problem is going to come with the idiots who didn't roll over their debt, who didn't lock in long-term interest rates and went for the rolling debt. They're the guys who are going to be squealing.
Wow. All right. So, and to get back to my question, is your logic then, okay, U.S. has got a ton of short-term debt because interest rates are going up. That is going to balloon the debt service cost, which is going to eat more and more of just available money to spend stuff on.
Absolutely.
Right? And that is what's going to force the rationalizing on fiscal spending.
At some point, absolutely.
Okay.
And it's the U.S. will have to tighten its belt, and it'll have to decide, okay, what do we give up on?
Right. And sorry to interrupt, but in your answer, I've asked this as a related question recently to folks, and an answer that's come up is, hey, expect taxes to go up or new taxes to be put out there, like a VAT tax.
Yeah, you can expect new taxes. Whether that makes new revenue is, I think, up in the air. If you look at the U.S., you've had all sorts of tax rates since World War II. You've had marginal tax rates as up as 70% and as low as 20% and everything in between. Mm-hmm. And if you look at tax receipts as a percentage of GDP, it's always been between 20 and 22% of GDP. The U.S. tax intake every year is 20 to 22% of GDP, regardless of the tax rate. So, knowing this, the logical thing would be for the U.S. government to say, okay, let's just do a 22% flat tax and be done with it. Take 22% and, that's what we take anyway, rather than come up with a 7,000 page tax code, because that's what it is now. But
you're asking for logical thinking of the guys that just decided to make all their debt short-term debt. Yeah.
But actually, you have to, I tend to believe that the reason you have a 7,000 page tax code is that, just like in France, we have a 4,000 page labor code, is that there's enough in there that if the government wants to come after you, there'll always be something they can come after you with. Yeah. If you have a flat tax, then you can't. After all, Al Capone was done for tax evasion, right? Setting up the precedent that has been since then used many a time to get people to just plead guilty. So leaving that aside, if you look at the broader question, can we raise more money through taxes? Maybe, maybe not. The reality is U.S. tax receipts this year will be what, 4.8, 4.9 trillion. You're going to spend 1.3 trillion, 1.2, 1.3 trillion on interest expense. You're going to spend 2.6 trillion on Social Security, Medicare, and Medicaid. So that brings you to about 3.9 out of the 4.8. So that leaves you 900 billion for everything else. Now, if you want to continue giving 100 billion a year to Ukraine, that leaves you with 800 billion, and 800 billion to fund the roads, the army. Oh, by the way, the army itself costs 900 billion.
Right.
So now you have no money. You can't pay anybody's. Yeah. You have no money. So then you're going to have to decide what gets cut.
Right. And then there's entitlement spending. And this is something that Luke Roman, who you mentioned earlier, has been warning about for a long time, ever since short-term rates started their move, right?
Yeah. So I think all this to say that it's a long-winded answer, but the ability of the Fed to keep on raising interest rates when so much of the U.S. debt is at the short term, to me, is limited. So I think invariably where we're going to end up is we're going to end up in a situation in the coming 6 months where it looks like inflation is rolling over, and the Fed will be able to declare victory. We'll say, okay, we did our job. Well done. Well done us. Inflation is back to 4%, which is where they wanted it all along anyway. They don't want to come out and say it. But if you go back to what they were saying 18 months ago, that's basically what they were implying. They want higher inflation to basically eat away at the value of total government debt. Right. That's the only way you come out of this current predicament. So they'll get inflation to 4%, declare victory, and that'll be that. And once that becomes clear to the market, I think the US dollar rolls over hard. Or there's another alternative, is that inflation never comes down or comes back strongly. And again, the Fed's ability to do much about it is constrained by all this debt spending, and the debt levels, and thus you're stuck. So I think the Fed maybe has another 50, maybe 75 basis points in it at most. And beyond that, if you go much higher, you start getting into debt crisis territory.
Okay. So got a number of questions outside the US, but let me do lightning round with you to roll out finish up the US here. Is the Fed probability the Fed will be successful in pausing rates at some point soon and holding them there through the rest of this year into next year?
Yeah, I think that's high. I think they'll do, again, I think they do another 50, 75. And if they haven't cracked the bond market, if that doesn't crack the bond market, then they'll pause and stay there. If it cracks the bond market, then they'll roll over.
And that's kind of what I'm asking is, do you think they'll be able to hold it there, or do you expect probability-wise that the bond market will break?
I think that for the bond market to break, we need oil at $150 first.
Okay.
I think it will be energy that ends up. Most people look to the Fed. Most people look to interest rates to break the back of the current current asset prices, of equities, of bonds, of economic growth in general. I don't think it'll be done through interest rates. I think the break will come from energy. So as long as energy doesn't go to $150, then yeah, the Fed can maintain interest rates where they are, and things will stay on an even keel. Oil goes to $150, you get your bond market meltdown, you get your equity market meltdown, and the Fed is then in a real pickle. The reality is the uncertainty is not the Fed. The uncertainty is energy. That will determine everything. And that's why I've been saying for the past few years, forget bonds as a portfolio diversification. Your true portfolio diversification is energy. And there's many different ways you can play energy. But you need to have a lot of energy in your portfolio, because if and when the markets really break down, it will be triggered by energy.
All right. Hold that until we get to the capital allocation part of the discussion, and we'll dive deeply into that, because folks are going to be really interested in that. And I want to give a quick note that on that exact topic of the importance of energy, Wealthion's upcoming conference, which is in a little over a week and a half, we have Doomberg there speaking exactly on this topic. And I just recorded that discussion with Doomberg. It's a great discussion. So if you're interested in energy, in addition to hearing what Louis is going to tell us in a few minutes, go to the conference. In fact, quick plug for it. Go to wealthion.com/conference. You can register for it there. All right. So Louis, getting back to our rapid fire here. So it sounds like from what I'm hearing you say is, look, especially if oil goes to 150 and the bond market breaks down, that's really bad. But even if the Fed holds rates for the rest of the year here, it seems like that's going to really continue to depress economic activity here in the States. And
I'm not sure it is. It is.
Because that's the question I want to get. The question I want to get to is, what do you think of the recession odds in the U.S. this year? Maybe not so high.
Yeah, I don't think they're as high as most people fear them to be. Look, I think we still have a very tight labor market. I think wages at the low end are going up. I think Social Security payments at the low end are going through the roof. I think the cost of living adjustment was up, 8.7% this year or something. That's an extra $165 per month per Social Security recipient. And that's money that gets spent. So all the people who work in McDonald's, Walmart, who are getting social transfers, they're getting more nominal dollars than they ever have. Their wages are going up. Their labor market is still tight, and
real wages are going down. But yes,
but that money is getting spent. All of that money is getting spent, and most businesses think in nominal terms more than real terms. So you're still seeing rising sales at businesses. You're still seeing and that's the reality of inflation. Is your first sort of 5, 6, 7% kind of feels nice, actually, if you're running a business, if you're a wage earner, especially at the low end. Perhaps not in the middle class, but at the low end, it doesn't feel that bad. And so, no, I don't buy the recession story. I don't lose much sleep over it, because look, my take is, it's a bit like what happens if you throw a recession and nobody loses their job, which is where we are, right? For all the talk about ISMs below 50, inverted yield curves, which I don't believe is a valuable signal. On this inverted yield curve story, since it's the one that gets bandied about the most, the UK, Australia have spent the better part of the past 3 decades with inverted yield curves. And that didn't mean they had recessions. And if you look through the 1950s, 60s, and 70s, the inverted yield curve was a horrible indicator. It never told you anything. I think there's for me, the main message on the inverted yield curve is just the messed up supply dynamic of and the term structure of U.S. debt. It's just there's not enough supply at the long end and too much at the short end. That's it.
Okay. Well, your answer makes my next question even more interesting. So it sounds like you're not that worried about the U.S. going into recession anytime soon. Now,
I want to be clear. I'm not super excited by U.S. growth. I'm not.
Yep. You're not calling for gangbusters. Yeah.
I'm not like. I just think the whole U.S. is going into a recession, etc. I think it's a red herring. If I look at the market, the worst performing sectors this year are healthcare, utilities, and staples. Like exactly what you would buy if the U.S. was going into a recession, right? Exactly what you would buy with an inverted U.S. yield curve. And yet these sectors are being complete dogs. And they've been dogs with fleas now for a while. So, when you look at the equity markets, the message from them isn't that you're facing this big recession. It doesn't mean you can't have a small recession, but I think that whole discussion is a bit of a red herring, to be honest, relative to some of the bigger issues that are unfolding right now.
Okay, and I'm desperately trying to get to them. Sorry, I'm taking so long.
No.
We talked at the very beginning about China's reopening here, right? And so the question I have with it is you talked about the countries you think will do well for it. You will do well from its reopening, but in terms of the global economy, how big of a deal do you think this is going to be? Is it going to be kind of like a sugar rush, right? Where this gets unleashed and everybody feels good for a couple of quarters, but then it kind of just trickles away, or is this something that's going to have much more long-lasting impact?
I'm going to cop out on this one. I'm going to say it's too early. I'm going to say it's too early to tell. I think what you're seeing right now, and I've called this in a number of conferences I've given, etc. I've called this the she pivot. Everybody was looking for the Fed pivot, but instead we got the she pivot. And it wasn't so much the pivot about COVID policy as once China decided to reopen, the Chinese government also got rid of the red lines on real estate lending. It recapitalized the local authorities to get capital spending again, and for a very simple reason is the Chinese government now needs to build goodwill again. With their 3 years of crazy COVID policies, they've managed to piss off most of the population, and so now.
And you're talking about their domestic population more than their trade partners.
Okay. No, their domestic population. The trade partners actually weren't that affected, to be honest. If you were Apple, you could still produce in China. If you were Tesla, your factory was still working. So no, they've pissed off their local population, and that to me is the very important shift happening in China today. Is that, for my whole career in China, there was always huge buy-in from local population vis-a-vis the Chinese Communist Party. The belief was we used to be here and now we're here and we're heading here. These guys are doing a great job. They're the best technocrats around. And after 3 years of COVID policy, all of a sudden that belief has been shattered.
Yeah, these bastards have been my jailers the past 3 years.
Yeah, exactly. And by the way, I think pretty much any right-thinking person anywhere in the world looking at their own policymakers should be thinking, I used to think you guys were smart, but after what you pulled over COVID, I think you guys are dimwits. Everybody has the right to think that, perhaps except the Swedes, since the Swedes were the only ones to not follow the stupid lockdowns and mask mandates and, vaccine mandates and whatever else. So the Swedes should be proud of their government. Everybody else should be really embarrassed. But China amongst them, China for sure. They kept this thing going far too long, except perhaps with the exception that they didn't do the vaccine mandates. But they kept this thing far too long, and so now they need to change the story. They need a feel-good feeling, and so they're goosing it up. They're goosing up the economy, and that's why I tend to think that this is going to be more than a sugar rush. Well, it depends how long you call a sugar rush, but I think this is a story for the next 12 to 18 months. Now, whether beyond that it builds its own momentum, or to your point, it just creates like this huge momentum for 12 to 18 months and crashes on the other side, I think it's a bit early to tell. But I think the next 12 to 18 months in China are going to be strong.
Okay. I am no China expert. You know it worlds more than I do. I do talk to folks who say, hey, for the narrative that we had over the past decade of, hey, at some point we're all going to be working for Chinese overlords. They are maybe increasingly skeptical of that, just saying, look, China's got a lot of internal problems of its own. And certainly, what's been going on with their real estate market is a great example of that. How well positioned is China from here?
Look, the funny thing about China is it does trigger these passionate feelings amongst people, where people will either explain to you that China is this horrible house of cards, that it's all about to implode and it's all going to collapse, or alternatively, indeed, that if you don't learn Chinese, you'll never get another job. There's sort of nothing in between, which always struck me as somewhat odd. And yeah, to your point, China has some real challenges. We mentioned the demographic one. There's a policy one today where, China did have the big comparative advantage of having massive buy-in from the population, the policymakers having massive buy-in from the population. I think they've lost some of that in the past 3 years. The real estate situation right now, no, it doesn't prevent me from sleeping. For a very simple reason is China is the one country in the world where mortgage rates have just gone down 150 basis points. What other country in the world has seen mortgage rates go down 150 basis points in the past 12 months? The reality right now in China is, for 3 years, people did nothing but go to work and go home. No going to the restaurant, no buying yourself a new car, no going on holiday, work, go home. And so they've saved up a lot of money. Household deposits have never been this high. And now you come out of confinement and you realize, hold on, for my same mortgage payment, I can buy an apartment that's 30% bigger. Am I going to do that? Perhaps. Or perhaps, I can buy a Mercedes for the same price, same monthly payment as a Toyota. Maybe I should upgrade my car. Or maybe I go on a foreign holiday. I don't know how the Chinese are going to spend their money. Obviously, it'll be individual decisions by everybody, or maybe they'll do what the U.S. did and embrace financial speculation into all sorts of crazy stuffs, whether cryptocurrencies or SPACs or Peloton or whatever else the U.S. did when Americans had a lot of cash in their pockets. But today, Chinese have a lot of cash in their pockets, and historically speaking, they have had this tendency to deploy it in real estate. That's what they've historically done. And so with mortgage rates at record lows, record cash in their pockets, I don't see this as a sort of backdrop where I all of a sudden have to worry that real estate is going to crack. Quite the contrary, I think it seems the odds are decently high that real estate prices rebound.
Okay. I can ask you so many more questions, but I'm going to try to keep this going because I do want to get your capital allocation at the end here, but I want to tackle some of these big, structural issues you mentioned. So staying on China for a second, but pulling America into it. So let's talk about the increasing strain in the Sino-US relations and I guess maybe the Taiwan flashpoint. How concerned are you about the direction that's heading? There's definitely headlines out there that say war is brewing, war storm clouds. Some people are on the social media channels saying it's imminent. Is that something that you worry about?
Look, whenever you see headlines about wars, it's never great news. And it definitely means, if nothing else, that the willingness and ability to invest for the long term is compromised. Right, those clouds. So of course it has to be a concern. Now, do I think China's about to invade Taiwan? I don't. I think people completely underestimate the just the simple logistical and military challenges of such an operation. While it's easy for Russia to send tanks through cornfields and wheat fields into Ukraine, Taiwan sits more than 100 miles off the Chinese coast. It's a chain of mountain, 12,000 that go up to 12,000 feet that fall into the sea. There's basically 3 beaches that are big enough to do an amphibious landing on. So it's a natural fortress. So much so that in World War II, when the U.S. started to roll up the various islands and thinking, okay, we need to build to gain assets from which we can fly sorties into Japan. Initially, they looked at Taiwan, and the U.S. military itself decided Taiwan is impregnable. We can't take Taiwan, and that's when the U.S. decided to take Okinawa instead. They bypassed Taiwan and went straight to Okinawa. Because they figured that invading Okinawa was logistically easier than invading Taiwan. So, simply put, China has an untested navy, an untested air force, an untested army. Hasn't fought in a war since the late 70s, when it got its ass kicked by the Vietnamese. The odds of China trying to pull this off, for me, is slim to none. The regime realizes full well that if they pull this off and it fails, that basically it could be the same thing as Argentina trying to invade the Falklands. It'd be the end of the regime. So it's why take that risk? The only reason you take that risk is if one of 2 red lines have been crossed, and those red lines have always been no independence for Taiwan. Taiwan doesn't declare independence, and no foreign troops should be stationed in Taiwan. And here, this is where, of course, the U.S. has been rattling the cage, because the U.S. recently announced that they were sending 200 Marines to Taiwan, crossing a clear red line for China, making a bad situation worse. Now, where I think this all ends up is actually a year from now, you have an election in Taiwan. And the Taiwanese themselves have very little appetite to be the next Ukraine, unsurprisingly. Who wants to be the next Ukraine? Now, historically, Taiwan has been very divided as a country, like most countries politically. You've had the Democratic Party on the one hand that is, fairly pro-independence, and the Kuomintang, Chiang Kai-shek's old party, which is much more pro-China, or more pro-China ties, much like do business with China, etc. Now, nobody talked about it in the Western media, but 6 months ago, you had municipal elections in Taiwan where, to everybody's surprise, the Democratic Party basically lost every major city. The Kuomintang ran away with it. The message for me that came out of the polls was pretty clear, is we don't want to be a geopolitical football. Thank you very much. And I think in a year's time, what you're going to see is the Kuomintang get elected, and once that happens, once U.S. politicians come out and say, hey, I'm going to visit Taiwan this month, the Kuomintang will say, please don't, just stay home. Please don't, just, we don't need you, stay home. And when they'll say, we're sending 200 Marines over, they'll say, actually, we don't want them. And that, I think once the Kuomintang gets elected in a year's time, China will be a whole lot more relaxed about the situation, and the ability of the U.S. to rattle China's cage by using Taiwan will be greatly diminished.
Okay. In some ways, maybe we can hope for that, because that does seem like
for sure. Not in some ways,
down.
For sure.
Yeah.
Like who wants a nuclear war between, look at it this way. If I was an American taxpayer, which thankfully I am not, because I'm not American, and I'd look at the past 20 years, and the U.S. decided to fight a war in Iraq, which was a disaster. And the U.S. decided to fight a war in Afghanistan, which was also a disaster. Both of these wars ended up with embarrassing defeats, massive loss of blood, massive loss of treasure, and I would say a loss of prestige for the United States on the global scale. To turn around and say, you know what, following these 2 experiences, let's fight a proxy war against Ukraine and perhaps a full-on war with China, strikes me as just absolute mind-blowing madness. And it's also, I think, nothing that the American people themselves want. Like who in America wants a war with China? Who wants to send their kids or even themselves die in the South China Sea? Nobody. So it's not going to happen.
Okay. Hopefully it does not. If what you think happens, do you see a thawing and an increased, olive branch, and hey, let's figure out better ways to work together?
Nope.
Or nope. Okay. And so in your answer to that, do you see China, continuing to ally even further with Russia and, some of the other sort of BRICS countries and creating its own sort of bloc? And I'll tack on to that. Is there a danger, if not of a hot war with China, of a true Cold War, sort of like we had with the Soviets?
Yeah, no, look, I think the world is increasingly splitting between a Western world that is, decently united, or perhaps as most united as it's been in a long time, and for lack of a better word, and it's Western world that of course includes countries like Australia and New Zealand that are not at all in the West, but they're just
Western culture,
Western culture, and a global South that includes countries like China or even Mexico that aren't in the South at all. Now, the big macro trend of the next 10 years is that this global South is integrating ever faster. For all the talk about deglobalization, what we're really talking about is the splitting of the world into these two blocks. But within each block, you're seeing accelerating integration. More trade from Africa to Asia, more trade from Latin America to Asia,
more trade from China to the Middle East.
More trade from China to the Middle East, more financial flows, more investments from the Middle East into China. And all this is happening at an accelerated pace, and it's going to increasingly happen in currencies other than the U.S. dollars. It might happen in Indian rupee. It might happen in renminbi. It might happen in Brazilian reais. It's going to happen in other currencies. All this trade, and to be honest, I think something has been broken between China and the United States. I don't think it's coming back. You can't put Humpty Dumpty back together again. I think in America they feel like China's being very provocative, but China feels the same way about the United States. Sending troops to Taiwan, banning sales of semiconductors. The view is there. If you're Chinese, the U.S. is trying to contain our growth and prevent us from achieving our economic destiny. I don't think we move away from that feeling on either side. So the one concern I would have when it comes to asset allocation is that if you look at this unifying Western world, increasingly that unifying Western world is becoming increasingly less attractive as a destination for capital from emerging markets. And here, you and I think, talked about this in the past, but the decision to seize the Russian assets was a watershed decision where all of a sudden, if you're Chinese, if you're Saudi, if you're Bahraini, if you're Qatari, you look at how Russian assets were seized and you think it's the Russians today, it could be me tomorrow. Right. So I don't want to deploy assets in the Western world anymore. Given these rising geopolitical tensions, I'm not certain of the safety of these assets. And the reason it matters is what we were discussing earlier, is most Western countries, the US, but also Britain, also France, are running massive twin deficits. You had the current account deficits and the budget deficits of France, of Britain, of US. You're talking 6, 7, 8, 10% of GDP. And historically, the way that circle squared itself was we sold overvalued London real estate to Saudis. We sold overvalued US treasuries to the Chinese. Right. We sold overvalued Vancouver real estate to the Chinese. So we bought goods from the Chinese, and they took their dollars and bought overvalued Vancouver real estate. And that's how everything washed itself out. But if now the Chinese no longer want to do that, or even worse, we don't want to sell it to them in the first place, then all these trade surpluses that China accumulates, China sells $50 billion worth of goods to the US every month. Well, if that money can't come back into US treasuries, it's got to go somewhere else. And that somewhere else is going to be Singapore real estate. It's going to be Dubai real estate. Mm-hmm. It's going to be Brazilian bonds. It's going to be Indonesian bonds. And all these other things that it goes into are going to re-rate massively. And I think this re-rating has started. One of the amazing stories that nobody talks about of 2022 was the enormous outperformance of emerging market bonds and also a number of emerging market equity markets. India, Indonesia, Brazil, Mexico, they were all up for the year in an environment where global equities were down 20%, where the US
Right.
dollar was up, where China was doing badly, where basically every macro trend was a negative one for emerging markets. They outperformed. And for me, the explanation is very simple. We now live in a world where emerging markets that for 25 years were always being redeployed into developed markets, those savings, those emerging market savings are not going to stay in emerging markets. And so the re-rating of emerging market assets has started, and it's the big trend of the next 10 years.
That is really interesting, and that is a sea change. That's a great transition to the market outlook, because I actually have a chart that goes along with the statement you just made. Real quick, before I ask that question, make that transition, is there any, I mean, we didn't even really talk about Russia per se or the Ukraine war that much. Is there anything on the global structural front that you want to talk about before we wrap that part of the discussion up? I just want to make sure I'm not leaving some massive elephant out of this discussion.
No, look, obviously the Russia war is the elephant in the room, but I'm not going to pretend that I'm a Russia expert, because I'm absolutely not. I didn't expect Russia to invade Ukraine. That I made a huge fumble there. Didn't expect it. Was very much taken aback when it happened. I spend most of my time looking at Asia. So who knows what happens there. I'm hopeful, just for humanitarian reason, that this war comes to a close very, very soon. But yeah, I have no particular insights that it does.
Okay, well, let's get to the transition then. So you created a table here of the 10 top largest companies by market cap for each of the past 5 decades. I'm going to put it up here, and I'm going to read this from the article I pulled this from. You can see how things have shifted with each decade. By the end of the 70s, 6 of the world's largest 10 companies were oil companies. By the end of the next decade, just 1 of them was. By the end of the 80s, 8 of the world's largest 10 companies were Japanese. By the end of the following decade, just 2 of them were. At the turn of the century, 7 of the world's largest 10 companies were tech-related. By the end of the following decade, just 2 were. At the end of the noughties, we got to come up with a better name for that decade. 7 of the world's largest companies were natural resource companies. By the end of the following decade, not 1 was. 2022 seems to have marked the turning point. The COVID rallies in tech were the final spike in an amazing bull market. These are all huge companies that make the foundation on which portfolios are built. But how many of 2021's, I guess this is when the article was written, how many of 2021's top 10 will there be in 10 years' time? I'd love for you to opine on that in any way you like, but I recall from the article, 2 of your key takeaways were: our interview with Louis will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. And be sure to hit the like button too while you're down there. And don't forget that Wealthion's online conference is now just a week away. Lock in our last chance to save price discount before it expires at midnight this Sunday by registering for it at wealthion.com/conference. And finally, if the challenging market outlook that Louis has detailed in this interview has you feeling a little nervous about the prospects for your wealth, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends, risks, and opportunities that Louis mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next over in part 2 of our interview with Louis Gav.